Hi, everyone. This is Bob Robotti. Thanks for joining us for our 2023 annual meeting. So the format is we're going to have some prepared remarks and kind of give you our overview of where we think the market is today, why we think and where we think the opportunities are. And we'll give you some specifics on that too, obviously. And then, of course, as Matt pointed out, there's a question and answer function. So at any time, if you do have a question, please kind of go ahead, please, and register it. Thank you. So here at Robotti and Company Advisors, we really are a community of stock pickers. And so there are two critical aspects of that, we think. The first one is that we're all focused on one thing of extreme importance, and that's valuation, right? That's what we're looking for. We're looking for companies trading in the public market price for far less than what the intrinsic value of those businesses are. But it's important also the culture, right? There are 14 people who love discovery. And the discovery they love to do is discovering public securities selling at sizable discounts to intrinsic value. It's also a collaborative group who all work together, and we have for an extended amount of time. And through the last post-financial crisis, a difficult period of time broadly for value investing, right? The entire group pretty much is kept together. If anything, we've selectively added over that period of time. So therefore, the group actually has grown larger and had introduction of new people and new thoughts in also. And of course, most of the people have been here for a decade longer. So therefore, the quantum of experience that we all have is dramatically more than what it was when we started. So we think that's really a differentiated asset. That, individual bottom-up stock research is something that is not broadly exercised anymore. And so the number of people who do it and have experience with that is far fewer, because many people have left the business, retired, gone to do on something else. So therefore, we think that it's a very much a differentiated advantage. So how did we get where we are? So there's some critical elements, right? It's an interesting period of time. For almost 40 years, interest rates went from being someplace in the mid-teens to a couple of years ago go down to pretty much zero. Actually, in parts of the world, they were negative. So that's an extended run, in one way, in one direction, which is critical, right? Because that sets the base and the valuation for every investment, public markets, private markets, fixed income, equities. And of course, what really happened exacerbating the new norm concept that this is it, this is the way things are going to be, was post the financial crisis, right? The central banks and federal governments decided they had that they were going to try to induce economic activity. And so what they did was they suppressed interest rates. So it's the modern version of the trickle-down theory, right? If you make money cheap, that will end up boosting the economy. Of course, it was a dismal failure. There really wasn't any economic boosting that really happened during that time. Instead, what we ended up was we created huge inflation. Right? And the inflation that was created was in financial assets. So financial assets tremendously inflated over that period of time, given the fact that there was free money. And of course, the vast majority of capital has piled into winning trades, and it's sucked it out of other investments which have underperformed, which you think creates the opportunity, which is obvious today and wide and large. So of course, what you do have is you have an extended amount of time of that economic environment being the same. You get this idea that, you have myopia of linear thinking. It's happened so long, this will be the case. This is the new norm. And so therefore, concepts like inflation is dead do then become something people talk about. But more important than talking about it is they invest capital predicated on that concept. So that's an interesting component. Jim Grant, I guess, is known as observing that in science and in engineering, knowledge is cumulative, but in finance, it's cyclical. And so therefore, we think that is so true today that the cyclicality of markets is lost on most investors. Here's a chart that goes through identifying the top 10 companies of each decade. And of course, it highlights that you really do there's a different underlying economic factors which determine the outperformance or the underperformance of different groups and industries and businesses. And this is part of the normal cadence of life. And so this is something that we need to be reminded of, especially given the extended period of time that we've gone through the winners have been the same winners for a long time. So that myopia of linear thinking, especially at such an extended period of time, exacerbates the risk that Twain pointed out here, and that is, it's not what you don't know that gets you into trouble. It's what you know for sure that just ain't so. And we think that is prevalent and pervasive today in the investment world. People have become convinced by that long experience, and there's fundamental mistakes because they haven't seen the change that's clearly started to take place a year or two ago. So we love this quote from Dornbush, a MIT professor. In economics, things take longer to happen than you think they will, and then they happen faster than you think they could. And the corollary to that, we point out, is the longer it takes, the bigger the adjustment is when it does come. Right? We would point out that it was back in the 2011 letter to shareholders that Buffett pointed out that bonds were priced, a critical word in his sentence, priced, valuation matters. They were priced to offer a return-free risk. Yet it took a decade for that to manifest itself. So, and of course, what we really have seen recently, I guess at the last Davos conference, one of the watchwords that came up was the reemergence of VUCA, volatility, uncertainty, complexity, and anxiety. And that's what happens when you're on a road and you're traveling down and have been going for a long time, and there's a sharp turn in the road and you didn't notice it, and you're on the wrong road and you don't know where to go and you don't know how to get there. So clearly that's what we think is going on the last couple of years in financial markets. And that's one of the reasons why, there's a disbelief that in 2022, both the debt and the equity markets could be down over 10%. What would you think when the the 10-year treasury, therefore the risk-free rate of return, went to 1.5%? So there was no margin of safety. And when that adjusts, valuations of everything, fixed incomes, equity, have to adjust to that realization that you've gone too far and you've made a mistake in your assumptions. And the flow of capital today is really interesting, right? A couple of years ago, right, the amount of money that was passively invested exceeds the amount of money that's actively invested. So individual movements of stock prices, we'd suggest today, in large part, really are this flow of funds. And it has less to do potentially with individual company dynamics. And to the extent there actually is individual company dynamics, we think that has an exaggerated effect on security prices. So there's yet more volatility. And so that movement of capital, and it's continued this year, continues to move into passive funds. And that's what happens. Capital overshoots. And so therefore we think that flow into passive funds overshoots, but also importantly creates the opportunity. And the opportunity is we have a high conviction that mispricing provides the opportunity, the likelihood that the next decade will be a decade of stock pickers and not index funds. So again, where are we today? What we think is clear and obvious and been demonstrated, that is the 40-year juggernaut in the bond market has come to an end. The post-financial crisis monetary policy of free money has evaporated. And the myopia of linear thinking has extended in one direction and has reduced the risk-free rate of return, and therefore has had a prevalent and pervasive misallocation of capital. So today's markets are experiencing what we could call financial brigadoon, right? So brigadoon, for those of you who recall, is the Lerner and Lowe play in the 40s, and it's about two gentlemen wandering through the moors of Scotland and coming across a idyllic little town. And it's lovely. And the next day they come back to visit again, and they find out the town's not there because the town only shows up one day a year every 100 years. So today we think financial markets, it's financial brigadoon. They're longing for a return of that transitory place that's existed for a long time that won't return for another 100 years. No wonder there's volatility and uncertainty in public markets, and therefore opportunities for thoughtful investors who do individual bottom-up stock research to identify opportunities. So we point out that, one of the major macroeconomic events last 20, 30 years, even longer, has been, right, the ascendancy of the Chinese economy, right? So China's economic advantage, its competitive advantage, has been a supersized sucking sound, giant sucking sound, right? Ross Perot was wrong. It wasn't going to be Mexico and NAFTA. It's really been China for an extended amount of time. And what China has done has sucked industries, jobs, and inflation out of the developed world's market, right? After all, Walmart's success is predicated on the idea that it delivered the benefits of lower cost of Chinese goods to the American consumer. Today, we think that China has matured into a very different economy. And because we all know that the only constant in life is change. And the ascendancy of the Chinese economy has also brought two structural changes that clearly are only beginning to manifest that have, we think, long-dated impacts and change its competitiveness and morph it into a different economy. It also, in the process, of course, has become the record-breaking, by far, CO2 producer in the world. And those two trends, we think today, are going to have a substantial call on both materials and capital. And we think that that's really creating two super cycles, right? The first one we talk about is globalization 2.0, not just China. We think the characterization as deglobalization is absolutely wrong. That's not what's going on. But globalization is something that continues to evolve, right? For over 10 years, plenty of businesses and industries have started to migrate out of China because the cost competitiveness for certain low-cost labor things, high labor content things, have gone someplace else because they're competitively advantaged today, and China's not. So that process is underway. And of course, the migration of certain businesses to other places in India, Southeast Asia, who are competitively advantaged from a number of different points of view, is accelerating because it's not only a cost advantage, it's also this realization you need to have supply chains that have some diversification to it. Therefore, you're not tied to one country. So that process, we think, is clear and underway. And with that, a huge call on materials, build out infrastructure, and energy. The other thing we pointed out is China, of course, become the largest producer of CO2 in the world. And our concern is as a planet for CO2 and trying to mitigate and therefore arrest the CO2 production means that there's an energy transition process is underway, which again is a tremendous call on materials and capital and creates new opportunities, which are extremely long dated. So, okay, so that's, there's some macro kind of stuff that we really do think that there are strong trends that are long dated, will continue to unfold. But of course, how does that work into our portfolio? What do we do? And so what we do, we think the Schumpeter's process, over 100 years ago, was identified the cycle of businesses and the cycle of capital, and therefore the ebb and flow in businesses and who does well. And in the process, one of the things we do is we always look for companies that are at the difficult point in their cycle, cyclical businesses going through difficult downturns. And what happens in that process is we think there's a particularly cathartic process that happens to these businesses. They right size, they pare back the productive capacity, capital doesn't go into them, they consolidate, competitors leave the industry. And so therefore, what you really have is a changing dynamic in terms of the industry composition. For industrial businesses based in North America, there's an ebb and flow, but there's a long secular trend that corresponds to the buildup of China's economy that has been competitively disadvantaged. So in many ways, this is a 40-year process that's been underway. And so what you have left over, we think, are some really compelling, interesting companies that are very different companies today than the industry probably ever has been, probably since its infancy, because the few remaining tough mudder competitors are in a position to be able to provide tremendous returns given the consolidated industry position and its ability to match production to end market demand and therefore control pricing and profitability. At the same time, not only has the cathartic process of this cycle been extremely strong for those remaining companies, as importantly, the globalization 2.0, not just China, and the economic advantage of energy transition and North America's position as the low-cost energy market means that there's competitive advantages that probably have an extended runway of opportunity for growth in North America's role in many of these industries, right? And again, globalization 2.0, and people talk about reshoring. Reshoring is a mischaracterization, right? Because there's probably more movement of businesses from Europe to North America given North America's low-cost energy, which is a long-dated competitive advantage. So therefore, it's not Chinese companies or Asian companies as much. Yes, that is happening too, but there's at least as much going on from Europe, and that's a trend that will continue to accelerate given the competitiveness of North American businesses and North American industry, given its energy intensive advantage. Okay, so now for the beef, right? And the beef is, okay, so here's some trends and here's some ideas, but tell me the application. Talk about companies. Show me how this exemplifies why these companies are so well positioned today and why our portfolio is not only does our portfolio have great ideas, but as importantly, there are plenty of other companies and industries that we fully understand that have similar attributes and similar valuation advantages where we are today. And so we're particularly excited, right? I guess, the old what's the Buffett comment, right? And that is we feel like kids at a candy store. So the confluence of events, the companies we understand, the work we do, we are really excited about where we are today. So David, why don't if one of my colleagues, David, could you help us and then go through Homebuilding, which is an example of one of our investments and how it manifests itself and how all of this, where the rubber meets the road. Thanks,
Sure,
David.
Thanks, Bob. So my name is David Kessler. I'm a portfolio manager with Robotti. And the example that I'd like to take you through is one that's worked out very well for us. And we continue to believe will have meaningful returns going forward. So Builders FirstSource is the largest domestic supplier of building products to professional home builders. Now, it's ironic because if you ask most experienced investors where you should look to find great stock ideas, a very common answer will be where everyone else isn't looking. But in practice, very few actually look there. So as cyclical businesses, such as building products distribution, begin to experience tough times, capital rushes for the exits, and very often in businesses of cyclical industries, the stocks will trade for far less than what it would cost to replicate that business. And that might make sense in the moment because the earnings at that time don't justify replicating those assets. But many cyclical businesses, such as home building, are essential and are clearly going to rebound, often to previous levels, if not grow from that point. So they're businesses you would want to replicate at some point because they will be able to generate more cash than with the value of their assets, or at least the best of the survivors will. And I want to make that's a critical point, is that you really need the experience to be able to pick out the best of those survivors. So here at Robotti, we have a group of 14 investment professionals, and we all share a common passion for investing, and particularly for uncovering hidden bargains. Now, each of us is drawn to different industries, different situations. We all have different experiences to draw from, but we're all in search of the same thing. And our individual passion combined with our constant collaboration is really one of our strongest competitive advantages. Now, all the time, I, along with all the members of the investment team, will get an email from Bob saying that he's going to visit Houston or Toronto or Omaha and has a few hours free. So he wants to know what company have we been looking at that are located in those cities so he can call management and meet with them while he's there. Now, in 2009, Alan Weber responded to one of those emails saying Bob should go visit with Builders FirstSource in Houston. Of course, the CFO was available to meet with Bob because no one wanted to talk to him. Investors had fled. Wall Street wouldn't go anywhere near the stock. So Bob's talking to the CFO, and the CFO tells him that when we get back to building 1 million single-family homes in the US, we'll generate this much revenue with EBITDA margins of 8%. Now, 8% seemed aggressive, given that margins even at the peak of the housing bubble hadn't even reached 7%. But the CFO went on to explain that the company had spent the last 7 or 8 years going crazy buying businesses, slapping them together, and it was a bit of a mess. So now, with time on their hands, management was busy restructuring the business logically, and they were confident they would be able to generate at least 8% EBITDA margins. So that meant if demand recovered to 1 million single-family homes, the company should earn $1.50 per share of EBITDA. Now, of course, by 2009, the home building business had been decimated. Single-family homes built went from a peak of 1.7 million a year to less than 500,000 homes a year, which was less than half of the 50-year average at that time of a bit over 1 million single-family homes a year. But during those 50 years, both the population and the number of households in the US had doubled. So to think the industry could get back to at least 1 million homes wasn't a heroic prediction. Now, since this is a distribution business, which isn't at all capital intensive, EBITDA isn't really the misleading metric it could be in some other businesses. So Bob realized there might be an opportunity to buy a business for roughly 2 times pre-tax earnings. Now, the company did have some debt, but it had also been a long-time holding of 2 leading private equity firms who believed in the business. So Bob figured the worst case, those companies may have to inject some capital, meaning dilution. But even if that meant it was trading at 4 times, it was still clearly a tremendous bargain. So we got to work analyzing the industry, learning all we could about its competitive landscape. And we learned one of its competitors was the Boise Cascade distributor, BMC, which was coming out of bankruptcy. The company had restructured, lowered costs dramatically, and though it did have some debt, it was going to receive an $80 million tax refund within 6 months that would allow them to pay off all their debt. The company hadn't yet relisted, so it continued to trade in this gray market with shares that were then owned by lenders who ended up with equity in a business they didn't want and wanted to sell. So Bob took this information and went to talk to the company. And the company wanted someone like Bob to invest, someone who believed in the business and allowed management to keep their jobs. So we went around to the banks who held equity and ended up buying a 22% stake. We bought it from them at a price that was substantially discounted because the stock had never relisted. So as a significant shareholder, Bob ended up joining the board. And that was very important. It was instrumental in allowing us to learn the business, learn what the company was doing and how they were doing things, and understand the entire opportunity set. It also gave us tremendous insight into the business and the industry. And significant opportunities came from that, but not without more pain. Now, it's interesting. It may even sound counterintuitive, but we actually want the pain sometimes to stay for longer periods of time. Because in general, the longer an industry is depressed, the more time there is for the cathartic process Bob mentioned to take place, meaning more consolidation, fewer competitors, more time for additional supply, and the larger the opportunity set for the well-run survivors to grow their earnings power in these downturns. So after initially buying shares of builders at $3.40 in May of 2009, we doubled down in 2011 at $1.70. The opportunity was getting larger, but the price was getting cheaper. And the market wasn't interested at all because it couldn't identify when the business would change. But we had very high conviction that it would and had the patience to hold tight. Now, when we first got involved, the market capitalization of both Builders FirstSource and of BMC were both below $200 million, essentially microcaps. In the summer of 2020, Builders FirstSource and BMC announced they would merge. And today, the stock, which is a combination of what were once the 4 largest distributors, sells for roughly $135 a share and has a total market capitalization of over $16 billion. Not a microcap anymore. And the story isn't over yet. The dynamics of the business have changed dramatically. And we can see that from 2022 EBITDA margins of not just 8%, but 19%. And we estimate on a normalized basis are roughly 15%. Now, before I hand it back to Bob, I just want to pull on another connected thread to illustrate what he said and mentioned in the beginning about how people, our passion, and our collaboration are one of our biggest advantages. So when I joined the firm at the end of 2009, I began doing some work on Builders FirstSource and BMC. And that exposure, combined with my prior summer internship experience while I was in business school, where I spent an entire summer analyzing wallboard maker USG, allowed me to identify and recognize a unique supply-demand situation unfolding in the oriented strand board industry, where the same cyclical dynamics had taken place, and so much capacity had been taken out of the market that, again, if we reach just 1 million single-family homes, capacity utilization would rise well above 90%, giving producers significant pricing power. And if we got back to 1.2 million, there might even not be enough supply to satisfy all of the demand, meaning prices would spike, something no one was pricing into the stock. We initially invested in Canadian producer Ainsworth, which was bought out by Norbord, and eventually bought out by West Fraser, making them by far the largest OSB producer in the US. And indeed, supply constraints have caused prices to initially have gone up by more than 5 times to all-time highs. And while they've pulled back, they remain well above historical averages, generating significant cash flow for West Fraser. With that, I'll turn it back to Bob.
So actually, I'm going to go a little off script here. So because it's one of the things that really differentiates us, right? When it comes to value investing, long ago, I worked for Mario Gabelli. And right, I think Mario pretty much was one of the people at the advent of the use of the phrase value with catalyst, right? You don't want to own a value stock. There wasn't some event that was going to cause the difference between price to value to dissipate. We don't invest, obviously, when we invested in Builders FirstSource, we didn't see what the catalyst was. There was no catalyst. But we were willing to take that long dated opportunity. Critical in that process, because we bought those businesses for far less than what it would cost. So we'd argue that we weren't buying $1 for 50 cents. We were probably buying $1 for 10, 15 cents. But an important component to doing that, to being in those things and not being concerned about being too early, is the ability also to not take a profit, not, the idea that it doesn't hurt to take a profit is absolutely wrong. When you have something you bought as cheaply as we buy these businesses and has a long dated opportunity to take advantage of the opportunity set. So, because I do recall in 2015, right? So David said we bought it at 340 and 9, we bought it more at $1.70 and 11. So in 2015, the stock got to $11, $12 a share. They did an underwriting at $10. So therefore, yes, you would have made a lot of money if you had sold the stock. The fact of the matter, as David pointed out today, the stock trades for $135 a share. So it was only at the beginning of the manifestation stage of the recovery in that business. There was a long dated opportunity, given how these companies had changed their position in the marketplace and the eventual consolidation of it, which is something that was in the works. Having been on the board of BMC, having spoken to the management of Builders FirstSource, that was something that was going to happen. There clearly was the logic and the motivation on the part of the owners to put those businesses together. So part of it is being able to stay in these businesses, not take a profit, not do some of those things, but really be able to fully capture the benefit, and also to not be stuck in a box, right? So we're not a small cap investor or a large cap investor, and therefore if a small cap investor does well and the company becomes tremendously a stronger, better business, to sell it because it's in the wrong market cap. So therefore we kind of break those rules. We do what's thoughtful and intelligent, not following some rule, and also clearly many cases investing in businesses with extremely long dated opportunities at extremely modest prices. And so that's a critical differentiator, we would think, between ourselves and a lot of other people in how we do invest, even in the value space. The fewer of us that are left investing in businesses like this that are cyclical, because that's, of course, something that most people don't do anymore today. Absolutely. So in economics, things take longer to happen than you think they will, and then they happen faster than you think they could. So our investments in offshore energy, two of them in particular I'm going to talk about here, exemplify this idea, right? So the first one I'm going to talk about is Subsea 7, right? So Subsea 7's business today, it's exactly what you want to invest in. It's owned and controlled by an owner-operator who's an extremely intelligent allocator of capital, who in the downturn, which is an extended downturn, and the longer that happened, the more opportunities that came to him that he took advantage of. So it was to consolidate other competitors and to acquire assets of far less than what it would cost to build those assets at a depressed time in the marketplace. So therefore, in that process, the number of competitors in this business are vastly fewer than there were before, to the point where in certain ways, they've also changed the business model in terms of how contracts are bid on, award, and designed and engineered, so that there's really a duopoly in the high end of the market, which is a methodology that more and more companies are adopting to have sole source conversations with either themselves or their large competitor, Technip FMC. So therefore not a competitive process, and more importantly, not re-engineered multiple times, adding incremental cost and delaying the production of first oil. The process that these two companies have adopted have really changed, in many ways, the economics associated with these offshore fields, and therefore made many more fields today, resource that people knew of, economically developable oil and gas at prices far below, concern that lower oil prices will in any way impede the economics of these projects. What also we'd point out is in offshore, historically, it was an oil business. It is not today just an oil business. It's an oil and gas business. Natural gas is one of the key discoveries that now becomes economic, because two things have happened. More and more local markets have demand for natural gas. So therefore, the Mediterranean, Turkey, are places where offshore discoveries of natural gas are extremely economic, and those projects are developed. That's not the case 15 years ago. They would not have been developed because it would not have been economic. So therefore, the opportunity set is substantially larger. But it's not just in the Mediterranean or off Turkey or discoveries off of populated areas. Discoveries off of Mauritania are economic because LNG today clearly is a growing part of energy transition. What you need if you have renewables and the intermittency of renewables, you need dependable energy. And what that means is natural gas is a critical power production method that's going to be accepted around the world. And the growth in the demand for LNG, which of course we saw a year ago in Europe, the shortage of gas that was created by the Russian cutoff of imports into Europe, meant that there's a huge growing demand. Of course, it's not just Europe, right? Asia has a tremendous appetite for LNG. So the number of projects that can be developed are vastly different. All of this translates into Subsea 7 today trades at 13 and change per share, and the earnings power of the company is easily over $3. In the meantime, the market doesn't realize that because the earnings are difficult to therefore understand and see through. Fortunately, we've been an investor in the business for 25 years, so we understand the dynamics. So the earnings manifestation is only starting, and it has a tremendous amount of momentum, and therefore its position today is one that's particularly compelling. What Subsea 7 also does for us is also provides us this grassroots macroeconomics, concept that we have. So 10 years ago, Theo identified that as, okay, so it's difficult to know macroeconomic events, but the fact of the matter is if you know a company, you know an industry, and you understand its suppliers and its consumers, you start to build out an understanding of critical elements in the movement of the economics of certain portions of the economy. And therefore, what we see is the opportunity growing offshore. And the way that's manifested itself is, of course, our investment that we've made in Tidewater, the offshore boat company, right? They have boats that service offshore drilling platforms and offshore rigs. And that business is one that also has gone through, it's exactly the same kind of example. Difficult business, cathartic process, the supply significantly reduced. Eventually, the demand starts to recover because the business is one that has needs, and therefore the energy transition is really emphasizing the need for reliable energy, and that's problem that has been identified, and therefore that means the interest is long dated in development of these fields. And you see multiple things where the European oil and gas companies, which are concerned about green and the environment and CO2, clearly understand that and are committing capital on very long periods of time, given their conviction the world's persistent need for hydrocarbons is going to be part of the energy transition process. And so therefore with Tidewater, you have a company that went through a restructuring, came out with no debt on the balance, no net debt. So debt and cash equal to each other. So clearly a survivor in which you could buy boats for pennies on a dollar. Then 2 years later, merging with another company, which had gone through the same restructuring process and came out with the same net debt free balance sheet. Combining those businesses, taking out $60–70 million of cost. So therefore, improving the competitive staying power of that combined business and preserving that strong balance sheet for the eventual recovery in the business. And that's what happened was. So then 2 years ago, here, like in BMC, I joined the board of the company because I believe that the opportunity is a long-dated opportunity, and to have conversations and understand and to be able to have input into that process enabled us to be in a position to help in that process. And not that we're making anything happen. It's the management and the existing board already understood that dynamics, had built the business, had positioned it. Since then, the last 2 years, of course, Tidewater's made 2 acquisitions. The first one from Hong Kong-based conglomerate Swire Pacific. They bought their fleet, 50 vessels, a little over $200 million was the purchase price. Those assets would cost $2 billion to build new. All well-maintained equipment, high-end, relatively new pieces of equipment. So some of the newer pieces of equipment in the field. So therefore, an extremely tremendous acquisition. So not only did you buy assets for far less than what it was worth, what also happens in that process is you took significant cost out of the combined company. So you get synergies from that. As importantly, in certain markets where we both had a market share, the concentration in improving situation enabled us to more quickly accelerate getting prices that the assets justify to be able to get a reasonable economic return on the value of that asset. And so therefore that accelerated the pricing advantages that we've been able to manifest in that process. And then June, the same opportunity, another opportunity similar. We got the opportunity to buy from a distressed Norwegian company that for 8 years the banks haven't been able to get any money out of, that are concerned that they're not going to get back their loans, and therefore force the sale of a portion of their fleet to us for a little less than $600 million. That's $600 million for 37 vessels works out to $15 million a vessel. Those vessels to build new today would cost $60 million. That's relevant because every one of those vessels is in demand, it is working, and therefore economic. And the rates on those are dramatically changing because that's what happened. The supply and demand situation in that marketplace has come into balance. The supply had dwindled after an extended period of difficult time, and therefore demand returned somewhere near its historic level. And so therefore you got to the point where utilization rates, effective utilization rates, are extremely high levels. Rates dramatically improve. All the rate increase falls to the bottom line. The economics go up dramatically. So today, Tidewater, the current trading price, probably has a $3.2 billion market cap in the company and has a $3.7 billion enterprise value. By the end of 2024, the cash flows are dramatically improving, and therefore there's a good chance the company is debt-free by then. So $3.2 billion divided by 229 vessels, you're paying $16 million a vessel for that business, far below its replacement cost. But importantly, because the recovery is underway and still gaining momentum, the less than probably what the cash flows are over the next 4 years, 5 years. So you'll get back all your money in that period of time and yet have assets that have an extended life to them. Now, for extended life, it's interesting kind of where these things go. Because the CEO of an offshore drilling company made the comment to me that he thought the offshore equipment market would end up looking like the Cuban cab business. And by that, of course, he's referring to, if you go to Cuba, the cabs you drive are cars that were built in the 50s, in the 60s, and you can't get a new car in Cuba. So what you do is you rework the engine, you slap a new coat of paint on it, and you send that car back out on the road. So there's a possibility of a confluence of events that means that the long-dated nature of these assets is very different than historically, and therefore a different environment, and therefore a particularly positive one in terms of free cash flow generation. So I'm going to turn it over to Theo. Theo's going to give you some ideas on a number of different companies that we had the good chance to spend some time in Chile together and find out more about the opportunity. Take it over, Theo. Thank you.
Great. Thanks, Bob. So yeah, my name is Theo Vandermeer. I'm a portfolio manager here at Robotti. And before I get into what I want to talk about, I just want to quickly remind everyone that you can submit your questions throughout the presentation. You don't have to wait till the end. So please continue to send those questions in. I see we already have a couple really good ones in the queue, and I'm excited to see even more. So anyway, in our daily routine, we spend a lot of time scrutinizing financial statements and market data. However, part of what sets us apart is our commitment to going out into the field to gain firsthand insights. So as Bob said, we recently went on a trip to Chile, and where we met with the largest Caterpillar dealer globally, a company called Finning International. And our trip involved engaging with senior management teams, on-the-ground operators, and distribution centers, repair facilities, and even the operators of the copper mines themselves. And this kind of immersive fieldwork is an integral aspect to our investment approach, as it allows us to uncover vital information that can sometimes elude just the financial analysis by itself. So Finning has been in part of our investment strategy for some time now. It's a picks and shovels type business, which by that we mean it's the thing that sells the picks and shovels to the companies that use the picks and shovels. And so because of that, it fits our investment profile pretty perfectly. We favor these types of companies for two primary reasons. First, they tend to be repeatable. They offer a degree of predictability that we value, and they also allow us to gain exposure without the risks associated to those companies that are actually wielding their tools. And secondly, they provide us with a unique window into a multitude of related industries within their sector. So through our investment in Finning, we've developed a growing interest in the copper industry. And despite limited investments in this space outside of our investment in Finning, we think that we're in the early stages of something that's really quite promising. And this goes back to the grassroots macro philosophy that Bob was touching on earlier. Through our direct engagement with an industry's fundamental components, such as its customers, its suppliers, and competitors, that helps reveal the macro level trends. And in this case, in short, what we think we've revealed is that the world is facing a significant looming copper shortage. And we had a conversation with Codelco, which is the largest copper producer in the largest copper producing country, Chile. And they confirmed that despite ongoing investments, copper production won't meet even the low end of demand estimates. And on the demand side of the equation, the growth of renewables has created bottlenecks in material supplies. And when you combine that with bottlenecks created from other industries that are experiencing growth, it's creating a lot of opportunities. And to reiterate one of Bob's favorite quotes as of late, which I think he's already said a couple times today, is things take longer than you think they will to happen and then happen faster than you thought they could. And that perfectly encapsulates what the copper industry situation is today. Really lengthy mine startup times, these take years to start up, mean that even if the industry decided today to increase production significantly, with all the capital that entails, it simply won't be able to meet the demand in time. And while setting the table for copper's future has taken many, many years of underinvestment, depleting of existing resources, and this growing electrification of the world, once that shift truly flips over and undersupply takes hold, things will likely progress very, very quickly. And this scarcity of copper opens up numerous investment opportunities across the sector. It's not only a matter of investments we've already engaged in, like finning, but also extends to copper recycling companies, direct producers, innovative alternatives to copper, and differentiated extraction technologies. And our investment strategy is further influenced by another theme that Bob also touched on, globalization 2.0, not just China. And basically, what we're talking about here is that the deflationary impact that China has had on the world for the last few decades, simultaneously with the world giving way to reshoring, where companies are moving production back to the domestic markets, are really creating a bunch of opportunities. Further, we believe China has really been in a recession for the past 2 years, and that's led to questions about the future of commodities and the future of demand profiles. And a question we often get when we talk about some of these companies is, what happens when China's demand falls off? But we've kind of already to see a world, what a world looks like with China's huge growth engine not going at full tilt. And what we're observing is that these companies are still generating pretty strong results, even as China's consumption patterns change. And this isn't only a valuable data point for our commodity investments, but also significant advantage for all US-based companies. If you want to go to the next slide here, Bob, our abundance of cheap natural gas provides a huge competitive advantage, particularly for our investments in the chemical sector, such as companies like Westlake, Olin, and LSB Industries. And being a low-cost producer in a market experiencing industrial growth is a recipe for success. The U.S. offers both cost-effective feedstock and lower production costs in the form of low energy costs due to the lower natural gas costs. And when you add in initiatives like the Inflation Reduction Act, you're expected to boost domestic demand even further. So you can see how both of those things are coming together at the same time to provide really strong opportunities. Some of these companies are still in a show me phase. For instance, Olin is reducing its production of caustic soda, which is a foundational material that's used in pretty much any product you can think of. And this strategic move aims to raise prices, and we think that they'll likely be successful in doing that. And if they are, it will showcase really intense pricing power they have and control that they have in the industry. And so if you look at the chart here on this slide, you can see just how stark the price difference is between US priced natural gas in the world and how much of an advantage that should bring to all energy intensive US companies, especially ones that not only use natural gas for electricity, but also use it as a feedstock, which many of these chemical companies do. So our exploration into the copper market, our understanding of globalization 2.0, not just China, the structural advantages of the US, and our existing portfolio has presented us with exciting prospects across various sectors. We're really energized by the opportunities we're seeing across this ever-evolving landscape, and think that the next few years are going to be some of the best we've had, and we're really excited for what's lying ahead. So with that, I'll hand it back over to Bob, and then we'll get to some Q&A. Bob?
Yeah. So with copper, as Theo mentioned, our investments to date have been relatively modest, because that's what we do think. We think, the at the risk of repeating it too many times, in economics, things take longer to happen than you think they will, and then they happen faster than you think they could. So everybody knows about the looming shortage of copper. And everybody said, and investors in space say, yeah, but next quarter, the copper price is going down. I don't want to own the stock. And so it really is a long-dated opportunity. And as much as what we did was, how does the industry work? What are the different elements? Where can you do a supplier of equipment, a mining company, a recycler, a recovery of copper out of the tailings of mines. So we continue to do work because the opportunities when they start to unfold are dramatic. And I point that out in Tidewater. Right, in the last 2 years, as the stock has moved higher, a number of times I've been an incremental buyer at higher prices of the stock because the running room has finally started to manifest itself. And the long runway of opportunity provides the ability to put more capital to work. So therefore, with copper, I'm assuming that's really the opportunity set. We want to know enough. We know a lot about the business. So therefore, as it starts to unfold, we think there's a long dated opportunity and we're going to understand how to deploy capital. So, that's a critical part of energy transition. And energy transition is something that opens up back here to the industrial revolution in North America. Right. The competitive advantage of North America in energy intensive businesses is clear and dramatic. And that is a really long dated opportunity. And that's why we think so many of the businesses we're investing in, since they are domestic producers who are competitively advantaged because they have the lowest cost of operations, given that low energy cost, are in a very different position than those businesses have been in. And they've consolidated down to very few players. And so therefore, the participants in the market are really tough mutters who understand that process. So one of the industries that we're excited about is, we're an investor in LSB Industries. So LSB Industries has historically been a producer of fertilizers here in the United States. So North American fertilizer producers are competitively advantaged because they have a much lower cost of goods. Therefore, because they're using natural gas. And so they're competitively advantaged against their European competitors who use oil and naphtha, and their Chinese competitors who are using coal. Those are two much higher priced hydrocarbons. So there's a huge and you see that, right? Because reshoring, as I said, it's not reshoring, it is shoring to North America, because much of that is coming. And in the fertilizer business, you see Yara, one of the largest producers in the world, which is a European-based business, is in the process of building 2 new plants in North America. And that is based on the confirmation of the long-dated opportunity. So LSB Industry is a company that, once again, the price of the products had gone up last year. In 2022 was a phenomenal year. And this is a recurring pattern. Many of these companies in 2021, 22 had extremely strong results, generated a huge amount of free cash flow. Today, many of these businesses today have net cash on the balance sheet, extremely strong positions, and yet have competitive advantage and pricing power. And in that process, what are they doing? Because people don't believe it. And stocks trade for very low single-digit PE multiples. And what are these companies broadly doing? Builders FirstSource bought back 40% of the outstanding shares in the last 2 years. Olin's buying back stock on a repeated basis. So these companies are buying back stock because the marketplace has it wrong, and therefore they could take advantage and they build value, right? They're building per share earnings, they're building the intrinsic value of the business. LSB Industries not only has all those attributes. Can you buy this business today for a third of what it would cost to replace that business? It's in the right place. It's economically advantaged. And its earnings power was clearly demonstrated in 2022. So therefore, it sells for a very modest multiple of its earnings capacity. Prices have already started to readjust again, going back up again. And importantly, energy transition is absolutely happening. And there's opportunities in these base businesses. Ammonia is clearly one of those things that's going to have applicability far beyond its historic usage, right? So we just had a call earlier today with Mark Bierman, the president, and he was highlighting that much of the business, they are looking to use that intermediate ammonia, and instead of making a fertilizer product that therefore is volatile in the end markets, to continue to sell more into the industrial marketplace because there's demand for that, or importantly, there's a new buyer in town, right? So they're looking at building a new project with the Japanese utility, because the Japanese utility and the Korean utilities are identified ammonia as a fuel to blend with coal to therefore reduce the CO2 production in their electric generation. So there's a new use of ammonia as a fuel that therefore does not create CO2 when it's burned, that is going to give it a very different role. So here you have a business selling for a fraction of what it would cost to build, that's extremely economic, that's competitively advantaged, that has a strong balance sheet, that has opportunities in front of it, that is a tremendous growth market. And that's what we think is repeatable, right? The repeatable is there's a barrier to entry. North American producers are competitively advantaged. There's a whole bunch of other advantages they have that really do give it more sustainability and better profit outlook. At the same time, Therefore, there's tremendous growth, and yet the price of which is very modest. So we think you have an Warren Buffett better business at a Ben Graham cigar butt price. And that combination of things has us excited, not only about the portfolio we have, but the opportunities that our research and the universe of people here understand and know well, have identified. And therefore, that's what I have, right? There are 14 people here. I'm one of those, but I got 13 people regularly come in my door, pointing out a great investment opportunity and say, you have to invest in this. And it's a compelling opportunity. The issue is I only have so much capital, so therefore I need to sell something. And so that's the limiting factor. But we're not short of investable ideas. And if that's just not what's in our portfolio, there's substantial ideas that we understand businesses. They're in our core competencies. And therefore, that opportunity set makes us extremely positive in terms of how we think the future plays out. So questions. Who's going to do the questioning? Who's going to do that?
I'll take a handle on that, Bob.
Great,
so actually, we have a question here that I think kind of relates to the point you just ended on a little bit. So we have someone asking, they were looking at your 13F and they saw that you recently sold down Builders. What was the reason for that? And can you talk about the selling decision?
Sure. So market irrationality and therefore stock movements being predicated on indices or algorithms and not based on intelligent thought. So the end of last year, we thought the valuation on Builders FirstSource was extremely modest, which we still think it is today. And that was because everybody was convinced that home building would fall off a cliff. And they also were convinced that if home building fell off a cliff, well, it's a cyclical business, Builders FirstSource, its earnings would go through the floor. The fact of the matter was that business has fundamentally changed. There's been a huge consolidation. The position that Builders FirstSource has, not only in distribution generally, but also more importantly in the value-added components, and that is off-site construction, their position, which is actually the position of the number one and number two in every market, probably was Builders FirstSource and BMC. So the consolidation and the combination of two businesses gave them a competitive advantage in off-site construction, and therefore fundamentally changed the volatility in that business. And that got demonstrated this year when home building did significantly slow down, but yet the earnings persisted. So the earnings ability of the company and the fact that the business has evolved, so therefore is nowhere near the volatility, meant the stock then suddenly investors got excited. And once the stock people got excited, there was an algorithm that says you should buy it. So the next thing you know, the thing went up to $150. So as importantly, probably more importantly, there's a number of other things that hit our radar that said, this is a really interesting opportunity that the market pushed down. And we thought were great places to deploy capital that gave us the ability for extremely long dated returns. So therefore we needed capital from someplace. And so the market gave us the opportunity. So we sold off some of our Builders FirstSource as the stock moved up to still modest valuations, but yet we were able to deploy it in something that we thought was substantially cheaper, and therefore we needed to come up with the capital. So it wasn't a sell in its own right. And if I had more capital, I might not have sold as much as I sold. The fact of the matter was the market gave me an opportunity. I could redeploy capital to something else, and we did that. So it's, as I said, today it still sells at less than 10 times earnings. The free cash flow is probably low double digits. The cash flow, what they're doing with it is they continue to make acquisitions in different markets and tuck in small competitors, and in that marketplace further increase their concentration and market control. So really great deployment of capital, and they buy back stock, increasing the earnings power of the business and increasing the earnings and the intrinsic value of the business. So there's a great thing for them to do. So it's an interesting company in its own right, but there's only so much capital in the world, and I needed other capital to invest in other things that we thought were extremely compelling.
All right. So speaking of some of those other things, we have another question here that says, I see that we have TDW and TWMIF, and that's Tidewater and Tidewater Midstream. What is the difference between them, and why do you own both?
There's absolutely no connection between the two businesses, other than they have the same name, Tidewater, in their names. But one of them is a land-based business in Canada that has pipelines and processing plants that extract natural gas liquids from natural gas when it's produced. And so therefore, and in addition, own a refinery, and in addition have a refinery business that they built out a new biodiesel refinery. And so therefore, we think that's a compelling investment. and one that actually in the marketplace has been underperforming, but one in which the asset values are dramatically more than the trading price of the stock. And actually that's on the way of unfolding because they've announced the sale of their Keystone project. I should call it Pipestone project because that's actually the name of it, which is a great asset with great cash flows and important, tremendous growth in front of it. And therefore a larger company was willing to pay them a market multiple as opposed to they trade at half of a market multiple. So therefore there's an opportunity. There clearly was some of the parts difference between those two things, and that's unfolding today. So, and Tidewater Midstream is part of that cathartic environment and people and whatever else, because the idea originally was Curtis Jensen's. And so therefore from my going to Calgary, once again, Curtis says, go talk to the people at Tidewater Midstream. So we build a relationship with them. We understand that business and we understand the market gives us opportunities there. So, and Dan Grisbach's another person who's regularly on those calls. So the three of us talk to the people there at Tidewater Midstream to stay closely in touch with what it does and then see what competitors do, including a company called Calumet that Dan knows relatively well and therefore has comparable businesses to him. So two totally unrelated investment ideas, both of which are compelling today.
Great, thanks. So I'm going to try and combine, there are a couple questions here about LSB, ag stocks in general, the energy transition, and what happens to LXU's earnings power if natural gas prices go to the mid $5, and view on natural gas prices more generally.
Well, of course,
so that's a broad thing. So
yeah. Well, let me answer the first one first. So last year, natural gas prices were 6 and change, and they minted money. So what ends up happening is natural gas is of course the input, and natural gas prices have some correlation between them. Now, of course, today natural gas prices in Europe are somewhere between 12 to 15, and so therefore at 6 in North America, it's still going to be half the cost of what it would be in Europe. So there's still a huge competitive advantage. So therefore, pricing will move around, but there's still going to be, the chart shows there's a wide difference between what it is in North America and what it is in the rest of the world. And that's because, right, that's a geologic fact, right? North American natural gas productive capacity is a multiple of what we produce today. We only produce enough, and that's what it is. Most drilling that goes on in the United States, Canada, is really focused on oil drilling. And so natural gas is a byproduct of a lot of that oil drilling. So we're not looking for natural gas because we have an abundance of it. So therefore we are supplied and probably oversupplied. And you've seen that even in the last 4, 5, 6 years, our ability to build out LNG and export natural gas has dramatically increased. So we go from 2 to 3 BCF a day to, are we 12, 15 BCF a day? So it's a multiple of what it is. And yet we easily fill that up because it's easy enough for us to produce incremental gas. So that differential in price, it will be volatile and will move, but it's going to be substantial and continual because we have much lower costs and abundance of natural gas, and the rest of the world is importing it. So therefore, it's a very different dynamic between us. So that competitive advantage will stay around for a long period of time. Did I answer? There was another part to the question though that I didn't quite get, and I think I forgot about.
I think something. Okay. Did you touch on the energy transition? But I think you spoke about that already earlier. So we have a different kind of energy related question, which is, do you have any views on uranium? Isn't that your body style cyclical recovery setup?
It absolutely is. And we need to do more research on it because it's an area that, we look at occasionally, but because we definitely think, again, energy transition is real. It will have huge impact, huge capital calls, huge opportunities, right? And part of that is going to be, in spite of the fact that Germany can't help themselves but want to shut down their nuclear plants, most of the world's going to look at building nuclear. And so therefore there probably is an opportunity there. So it's one in which makes all the sense in the world. We need to have competency in it. And so therefore I got to get 3 or 4 of us to really spend more time on it.
We have another question here. What's your opinion on other material investments, opportunities associated with the energy transition, such as lithium and nickel? And I actually might answer part of this first, which is there probably is a big opportunity in lithium and nickel similar to what there is in copper. And one of the reasons that we're invested in the company Finning is because they have exposure to all of these different things. So we do think that there is a general bottleneck of material supplies for the energy transition as a whole. And Finning is well positioned to, even if it's lithium that's really short or copper that's really short, what that means is that you're going to need to move more earth to get to those materials. And so if you can, Finning is a company that then gives the equipment to move more earth. So as that happens, Finning should do really well, which is why it was the initial investment we have in that space and is leading us down these other rabbit holes. So I'll let Bob answer the rest of it though.
Well, that's right, because Finning's business that's copper related is probably 10% of the total business. So there's many other end markets, and that's just not mining and materials, but there's power generation, construction. So therefore, Cat's business is much broader than just copper. So nickel is something that intuitively, again, is obviously a material is going to be in short supply. Lithium, I guess we have some interest in, and when we were in Chile, we didn't get around to, but we intended to visit lithium. There's more risk in my mind and uncertainty on lithium, just because storage batteries, how much lithium, how do you do that? There's I think, a technology risk. I don't think there's a technology risk in copper being displaced. The idea that you need more copper because of its critical role and is high conviction. Nickel, I imagine, is pretty much the same thing. It's there's a high demand for it, increasing demand, and therefore limited supply. Lithium, I think, is more problematic and confusing to us, and so I don't know if we'll be able to understand and parse out that opportunity, and how do we find that if investable.
Right. So this is a question that we got asked a lot back in 2020, and you addressed it in the 2020 meeting. But can you remind us of how the possibility of a Trump presidency affects our investments and portfolio policy?
Well, the first thing I'd like to say is I think the president of the United States, whoever that is the most powerful person in the world. So therefore, more than any other person, they probably have impact, especially on our own country. That said, when we think about the businesses we're investing in, and a lot of it is based on this concept that, there's an industrial revolution, that businesses in North America, we think, aren't, it's not the revenge of the old economy, it's the metamorphosis of the old economy. These companies are in a very different position because the industry structures have changed. And whether Trump's the president or not, we think that its competitive advantage will mean continued industrial recovery and growth in North America. And so therefore that well positions these companies. I don't think that that's something the Republicans or Trump have any interest in impeding. Is there an unintended consequence? Maybe. It's hard to believe that, though, that changes the investment parameters that we have here on the underlying opportunities in the companies we're invested in. So no, I actually don't think that Trump presidency really changes the calculus of our investments.
Right. So switching from North America to Europe, is there any European business or sector that you are particularly optimistic about?
Well, there are a couple companies that we do invest in Europe because, we're kind of agnostic. We recognize the headwinds that definitely industrial businesses have, but there's also opportunities. So there's a number of companies that we are invested that even are industrial businesses. A copper recycler that we think is particularly compelling. A Italian company that makes systems that do electric arc furnaces, and therefore we think the steel business is in the process of changing. Right, the decarbonization of steel production is a critical role. So therefore, for more of that to take place makes sense. So there's a couple investments we have that, are some kind of technology that therefore is a European company. And of course, generally, we think Europe, from a valuation point of view, does have like a headwind, right? Because capital has been migrating out of Europe, and therefore there's a general dislike, and therefore it's reflected probably in prices. So there's probably more opportunities kind of in Europe, but all of those are kind of one-off situations that our other investments in other companies leads to. In the meantime, of course, we have a number of investments in shipping companies and the energy companies, the offshore energy companies we're investing in, are European headquartered, but again, whether they do business in Europe or not is almost inconsequential given the worldwide footprint of those businesses, really. So we actually do have a reasonable number of investments that are European headquartered businesses that do business in Europe.
Great. So we have another question here that I don't know if maybe David wants to take part of this, but is the investment behind West Fraser a play on the housing market, or is there something more to it?
Sure. Well, it's because they produce lumber and OSB, it's certainly tied to the housing market. However, it's really, as we spoke about much in the presentation, part of that, Schumpeter's process or creative destruction, where really for a 25-year period, there had been a slow decrease in supply of OSB over time until right before and then during the housing crisis when there was a large supply reduction. And so it's really about a supply-driven investment idea where there's a supply constraint. It takes 3 years plus to build new OSB facilities. And while there are some coming online, while the producers can maintain capacity utilization of over 90%, they will have significant pricing power. Now, similar dynamic is taking place in lumber, a bit slower, but with the pine beetle kill and in terms of the harvesting in Western Canada, there's less places to plant trees. And a lot of that's moving to the eastern part of the United States. But over time, there's a decreasing supply of timber. So it's really, yes, it is tied to home building, but it's really the thesis or the idea is interesting because of the supply dynamics of the industry.
Mm-hmm. The other thing, David did point out there's a couple of OSB plants being built. Of course, the other side of that is the number 2 OSB producer in the country is Louisiana Pacific. And Louisiana Pacific is in the process of converting its business really from an oriented strand board business into 2 things. One of them is making a siding product. And therefore, in that process, has already converted 2 oriented strand board plants into siding businesses. In the process of converting another, recently bought an OSB plant intended to be restarted and instead is going to convert that to a siding business. So therefore, there is actually some diminishing of capacity in that marketplace as someone does that. In addition, oriented strand board is also something that historically has been used mainly for the home building business, but there's incremental new uses for oriented strand board. And even in the oriented strand board that a company like Louisiana Pacific makes, there's more, we think of a commodity product as a commodity product. The fact of the matter is even commodity products have all kinds of differentiation between the product, what it does. And therefore, there's a number of specialty oriented strand board products that for a company like Louisiana Pacific makes, and I'm sure West Fraser does too, that therefore have different attributes to it and therefore different price points. And in an industry with tighter supply demand situation, we frequently find that the intelligent, smart companies identify how to identify certain subsegments and products and therefore capture better prices because it has an attribute that the customer needs and therefore prizes and therefore will pay something more for it. So it's more complicated and therefore we think more opportunistic for high profits. David, I forget something. Yeah.
One thing I'll add is we always forget about this because we were focused on the housing aspect, but much of the additional supply that people were kind of like bolt-on supply that different producers were adding on were going to new industries and new customers that historically were not a part of the market. I think most of the additional supply. So there also there's significantly more demand from alternative sources that'll be able to absorb that, some of the oncoming supply.
Great. So another question here. What are the specific events you need to sell a position completely? And can you give an example of when you were wrong on a stock and why you were wrong?
What are the specific reasons to sell a stock? Everything in life is more complicated than that, right? There's almost never a one reason why. Right. There's a mosaic of things. So valuation clearly is always a key determinant for anything we buy and therefore anything we sell. And so therefore, if something for some reason sells for more than what it's worth, then we're clearly going to want to sell the position. And so, that's one determinant. But it's historically, of course, things that have worked against us, since we're frequently in early and therefore understand the business, probably are something we tend to buy more of. as opposed to sell out. So there is no rule of thumb here. Absolutely. We'd shoot the person who say, well, it's down 20% and therefore I sell it. So to let the market dictate whether you want to own a security or not seems to us to be a foolish thing. The decision to buy or sell something is predicated on the price to value, whether that's increasing a position, whether that's decreasing. What's the price, what we believe the value of the business to be. And therefore, that's the determinant for buying and selling any security. So that's the preeminent answer to when do we sell, when do we buy. Now, if you want to ask me, when did I make a mistake on an investment? We make plenty of mistakes on investments. As I say, we are early frequently. And so therefore, being early, we think doesn't mean being wrong. Now, maybe that's being pig-headed on our part, but the fact of the matter is the history and our experience has shown we frequently have been early. We frequently lost money out of the gate, and the ideas tend to be the ones that ended up being our biggest winners ever. So historically, investments that have worked out in the short term against us have provided us the opportunity to invest more capital when it became a much more compelling opportunity, and therefore we made substantial amounts of money from that. So that's what I would say as the converse. An area where we did, so 2014, 15, 16, 17, right? 05, 06, 07 is when we invested in the manufactured housing industry. So, our belief was that manufactured homes can be built, same square footage, in a factory in 5 days for much lower cost than what you would cost to build a home on site. And therefore, the industry had come down and dramatically corrected from 400,000 homes to only 140,000 homes. And we thought it was a compelling opportunity. I will point out this is around the same time that Berkshire Hathaway bought Clayton. That's the investment thesis that he had, that he therefore exercised, and how he worked out well for him. Did it work so well for us was he was the beneficiary because financing availability evaporated for that industry, which of course was, we think, also an extremely interesting story, given that Fannie Mae and Freddie Mac withdrew financing. And then, of course, 4 or 5 years later, right, they almost imploded the world's economy because they went out and did the same thing 10 times over for site-built homes. They didn't learn their lesson with manufactured housing. But that meant the cost of manufactured housing, the availability of financing was vastly different. So an $80,000 manufactured home would cost you more money down, higher monthly payment than what it would cost to buy a 210,000 site-built home with a reverse amortization mortgage and therefore a lower monthly payment. So the competitive advantages did manifest because the difference in the pricing and affordability given financing in that business. And clearly a lower priced home is one in which most people don't have the luxury of being able to pay for it in cash. So that is an industry. Now, what did we do? When the investments that we had didn't work out and actually file for bankruptcy, well, we bought Cavco, who bought those companies. And so therefore, once again, how do I stay invested in the idea? Because this is a competitively advantaged business. How do I invest in that? And so that's something we did 20 years ago. That's still in our portfolios today. The manufactured home companies we still own today.
And I would just add back to the question of what cause us to sell something. There are really 3 main reasons. 2 of them are kind of boring technical reasons, cash generation to get capital to buy something else, weighting change to make sure it's in line with kind of where we want the weighting to be. But as Bob said, the main thing is valuation. And to get to a full valuation, there are a couple ways that can happen. One is the company appreciates to a point where we think that the value has been appreciated by the market, or we find our thesis has been wrong for some reason or another, and it's changed, and so it's not as intrinsically valuable as we once thought, or the industry has changed in a way where it's no longer that same discrepancy between market price and intrinsic price. So full valuation is the main reason that we would sell out of something, but those 3 kind of portions of it are usually all in play whenever we do a sale.
Right. Well, although Theo, it's price to value, right? Because it isn't necessarily the price goes up to our value. Occasionally, the value can come down to the price, right? We could be wrong. Facts could unfold. We're not invincible. That's for sure.
So our next question is: what's the best way to take advantage of the recent oil discoveries in Guyana and Suriname?
Well, I think everything related to the offshore energy business is compelling today because I think the market hasn't moved fast enough to adjust to what the reality of it is. These are long-dated opportunities with consistency to that business and yet increasing demand. So not only whatever the increased activity is in Suriname and Guyana is also going to be replicated by increased activity off of Angola and off of Namibia and off of many other countries too. So therefore, there's an increasing amount of offshore activity. And, all the offshore equipment companies, of course, I talked about two companies in our portfolio. Subsea 7 is actually not a direct participant. They actually got their first contract in Guyana recently. And so therefore, potentially are a competitor. But of course, the industry is all interrelated. And therefore, Saipem's been like the main participant in the offshore field development. And of course, Saipem's capacity being absorbed means that they're not bidding on the contract off Brazil that Subsea 7 is able to win because it doesn't have a competitor bidding against them. So it's not a direct beneficiary, but an indirect beneficiary. In the meantime, Tidewater does have boats that do operate in that part of the world, and a number of the offshore drillers, right? Noble is probably an interesting company that trades for substantially less than what the replacement value of the assets are, probably something that equals the next 4 to 5 years cash flows. So therefore far less than the present value of its, all of its future cash flows. And, they are one of the large drillers in that area, providing service to Exxon since the original discovery, I believe.
Right. So we're at around 3:15 right now. I'm going to ask another question or two. Unfortunately, we're not going to get to everyone's questions that were asked, but we're happy to follow up with you after the meeting. So another question here is, do you have any exposure to healthcare related stocks? They typically are considered defensive.
Well, that's an interesting point. So we don't invest in stocks because that's a defensive position. So we don't play defense. We play offense. Now, when we play offense, we try to think about what we could lose too. And so therefore, we're not just looking to expose ourselves to extremely volatile things with high risk. And therefore, because that's what it is, right? The concept of value investing is not only is the price of the growth potentially attractive, but then also the valuation you're paying gives you a margin of safety, which mitigates against your losses and the risks associated with any investment. So therefore, but generally, we're not interested in doing something to have a defensive position. We're pretty much playing offense the entire time. That said, we do own a position in a company. Once again, the environment and the cathartic process. For many years, we've been investors in a company called RadNet, which is Alan Weber has identified this company years ago. And what it is, it's a company that owns imaging centers and has a dominant position in 3 different markets where they're the dominant out of hospital low cost provider. And in addition to the nature of its business and really good execution and its low cost advantage, and therefore continuing to have business migrate to them, they also have been an early adapter of using AI for imaging, which is continuing to have uptake, which has substantial opportunities for them. So that's a position that we do have that is healthcare related, that again wasn't based on it being defensive, but it was an aggressive position. We thought it was a business that sold for a fraction of what the opportunity was, and it's played out in large part as we thought it would. Thank you, Alan.
All right. And so maybe this will be the last one, or if you want to do one more after this, Bob. What level of leverage do you not feel comfortable with a cyclical business having when you enter into a new position?
Yeah, once again, there's never any hard and fast rules. As David pointed out, right? So we had our investments in Builders First Source, right? When we first invested in it, there definitely was debt on the company. And therefore that debt did create a risk, and that risk, it was a difficult time. It was going to lose capital. Now, what happened initially, of course, is it's a distribution business. So as the business wound down, there was actually positive cash flow that came from the wind down in inventories and receivables. So therefore generated capital, therefore mitigate the leverage that it had. But again, as David pointed out, our investment there was predicated on the idea that, there could be problems here. But we also thought that the ownership interest by particularly JLL, the private equity firm, meant that they realized the long-dated opportunity, and therefore if there was capital that was needed, we thought that they were a source of that capital, and sure enough that they did need to raise capital in that process. We got the opportunity to participate in that, and therefore we did participate in the rights offering. So therefore, frequently there are opportunities that actually come from the leverage situation. For example, Ainsworth is something, again, that was one of the oriented strand board companies that David identified a long time ago, and it had definitely a significant amount of debt. And the way they confronted that problem was they did a capital raise. They did a rights offering, and therefore they did that at far below what it was worth. And the capital raise, therefore, was the set-off point to huge recovery. Many years ago, Acergy, which was the predecessor to Subsea 7, again, needed capital, did a capital raise. So therefore, it provided opportunities to put more capital to work as the opportunity situation. And the capital raise, therefore, changed the dynamics of the business. So we think about that. We think about that risk. We think about the dilution risk, but we also think that the opportunity is more than offset by that. And then, of course, we also had the advantage to stay attuned to opportunities that developed. And so with Builders First Source, we identified the bankrupt company coming out of bankruptcy in BMC that we were able to invest in actually substantially larger amounts of capital than we had in Builders First Source, that therefore provided us phenomenal returns over an extended amount of time.
Great. Thanks, Bob. So do you want to do a wrap up, or would you like to see if we can squeeze in another question or so?
Let's go one more question and then we'll do a wrap up.
Okay,
Great.
sounds good.
Okay, great.
So we have a question here that says that they agree with your perspective on the economics of natural gas, but politicians seem to be doing everything to hamper that industry. How do you see that playing out? Do you think that creates stock buying opportunities in the short term?
I think it was interesting, right? So I spent 2 days in Houston at the North American Energy Transition Conference, and everybody there was a green company moving to green as quick as they can. And that's whether those are utilities or providers or equipment. But a universal chorus that was struck by even those people was, in the meantime, you need natural gas power to therefore supplement the systems when you have the intermittency generation issue. So therefore, I think the call on natural gas as a lower risk way to generate power and dependable in terms of the timing of it and when you provide it means that it doesn't matter what politicians do. Right? Even in Europe, they're trying to get rid of it. The idea that you're getting rid of natural gas anytime soon, there's no place on the horizon. So I don't think that that's really a concern and an issue. And what was the second part of but more importantly, the question you ask is, does it create opportunities in the short term? So once again, I am short capital. I am long opportunities. I am convinced that that oil and gas producers in North America, especially in Canada, trade at valuations that are disconnected from their economic value. So they trade far below intrinsic value. You can look at these companies and they trade at the next 3 to 4 years cash flow. You don't need a terminal value almost based on the valuations they have. And once again, they've made really good money in the last couple of years. What they've done with that money is they paid off all the debt they've had. Many of them are net cash. In a net cash position, they generate free cash flow. They only spend enough money to keep production flat and grow it slightly, most companies, and then return the balance of the money. So 50% of the cash flow is being returned in dividends and stock buybacks, and therefore further increasing the value. Especially, not only is the valuation discounted for the Canadian companies almost universally have 30-year inventory of drilling at the rate they're producing it, which is interesting because the oil and gas business always trades historically at modest multiples because it is a declining, depleting business that requires huge amounts of capital to be reinvested. Here you have businesses that have long-dated opportunities, are only investing a portion of the cash flow, or continuing to grow the business modestly, and can accelerate that at any time given the opportunity set in front of it. It's a perpetual business. Perpetual businesses trade for higher multiples. They should be than what the historic nature of an oil and gas business is. So we think the valuation on those companies is compelling, and we think the market opportunity is going to have a response to that. After all, we're reminded of the old phrase, Boone Pickett's made all his money on. Oil and gas is available on the stock exchange for far less than what the assets are worth, what their economic value are. And if they're far worth on the New York Stock Exchange, if you go to the Toronto Stock Exchange, they're further discounted. So we think there's a huge opportunity. The market's misvaluing these businesses, and there's plenty of reasons for that too. There's a number of investors that, in spite of the economic compelling nature of this investment, have been disinclined to want to invest in these companies. And so therefore, that's why we do think that acquisitions between the companies are probably the compelling thing. That hasn't happened because the industry has gotten temporarily disciplined and therefore won't lever up at all. And so it's a totally unleveraged business generating huge amounts of free cash flow. And someone's going to break the mold and lever up slightly, which they'll be able to pay off in a relatively short period of time and start to acquire businesses and have compelling consolidation opportunities. And eventually, once one does it, then people will see the logic of it because it is a compelling market opportunity that an inefficient market is providing. So with that, I guess we're going to wrap it up. So again, I can't kind of emphasize enough, this idea that there's 14 of us here, and that's what we do is we just love the idea of identifying companies that are trading in the marketplace for far below what the intrinsic value of the business is. And intrinsic value, of course, is defined as the present value of the future cash flows. And part of that is a longer dated viewpoint. 3 to 5 years, we're comfortable with making investments that potentially take that long to play out because historically that's shown to be the opportunity to buy businesses for far less than what they're worth. And there are many dynamics in these businesses today which make them compelling growth opportunities because the landscape has changed. The economic environment today is different. And that macroeconomics is a key thing, right? For the decade post the financial crisis, that was a headwind and therefore slowed down and therefore had definitely a negative impact on the companies we were investing in. And today that's turned around to be a huge tailwind and therefore providing huge opportunities to companies that have already improved their fact pattern, their situation, have strong balance sheets, have a limited number of competitors, and therefore give bright prospects to the future. And as I said, there's a whole bunch more of those than just what's in our portfolio. The ones that we have in our portfolio are compelling, but there's plenty of other places to deploy capital today that the world is ignoring. And the cash flows, though, will sound the alarm, raise the money, and capital at some point will realize it needs to be reallocated because we took a turn on the road. Inflation was not a transitory thing, probably, and therefore interest rates are still in the process of moving, yet capital is still rooted in financial brigadoon. We're going to get back to where it was. We're going to have no cost of capital. We're going to have low interest rates. We're going to have low inflation. And there's an awful lot bet on that. And if that turns out to be anywhere near wrong, there's a tremendous amount of capital that needs to be reallocated from huge amount of capital pools into relatively modest small cap companies. So therefore, a small fraction of it identifying this opportunity and getting over the conviction that it thinks it knows that business because of its historical pattern can realize it's the metamorphosis of that business into something totally different than it's ever been. And therefore, the opportunity is extremely strong. Thank you very much. And anytime you have questions, feel free to reach out to us. I think you can get the idea that we are passionate about what we invest in here and how we think about it, investing and how it's fun and thrilling. Thank you.
And if we didn't get to your questions, feel free to email them directly to us and we'll get back to you as soon as we can.
Thank you all. Take care. Be well. Happy Thanksgiving to you all. Bye-bye.